Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Chris Hall of Escalate Capital. Chris, thank you for joining us.
Thank you for having me.
Well, great. So can you tell us a little bit about your background before investing in early stage companies?
Sure. I started off my career as a management consultant. I really more fell into it. I was focused on investment banking or M&A, but when I graduated, the world was kind of falling apart. Banks weren't exactly hiring. So I kind of fell into management consulting, a number of different experiences across technology, healthcare, oil and gas, energy, and I enjoyed it, learned a lot, but I always knew I wanted to go back to business school. And I was interested in getting back in on the M&A side, or not back in, but I guess, for the first time. My original interest when I started studying this in undergrad, but I also liked the operational focus that I had developed over the past few years. So I thought I was trying to find what marries those two things between doing deals, but also having more of an operational focus or even having skin in the game. And that was what I was looking for. And then I learned about private equity and venture capital and thought that was really, really interesting. And then while I was at grad school, which was at UT McCombs here in Austin, I interned with some private equity firms and eventually met the guys where I currently work at and joined them after school. So that's how I transitioned into investing.
Great. So what's your advice for investors who are just now starting to join the growth equity sector? What would you tell them about investing in this space?
So it seems to be pretty competitive. A lot of money is coming in, but there are a lot of good companies from what I hear from my friends and former colleagues that have moved a little earlier stage, is that there are more developed businesses when you get started. So it's less about maybe the idea or the market size and more about the company performance. And while earlier performance is not a strong predictor of future success, it's one of the better ones we have, unfortunately. So there are metrics to understand how efficient this business is, how can it scale, what's the retention like, and you can actually talk to customers who use the product, as opposed to earlier on, it's more betting on teams and ideas and market sizes.
So how is the growth equity space evolving and changing? Venture capital is changing quite a bit these days, but what do you see as the impact, or where's growth equity going?
Well, a lot of money's coming in that's pushing up valuations, but there's also a lot of companies. So it's really a lot of focus on finding those companies. You always hear about startups talking about how difficult fundraising is, which it is, but also on the buy side, it's really tough to find high quality companies. So there's a lot of people looking for money and a lot of money looking for opportunities, but split up in their own individual mandates. So it's tough to find the right one. So it just seems competitive and always have to be out on the road and looking for. It's important to build your network and just try and find companies that aren't, I guess, on the market necessarily.
Well, we've heard about the funds getting bigger at the high end of the market, and valuations are going up as well. What other changes are you seeing at the market at the high end there?
Well, people are also getting from the cash flow negative private side using debt and a lot of what has formerly been more larger profitable company sort of capital structure methodology. But for startups, which as companies are staying private longer, raising more money, it's tough to build these big SaaS businesses or software service businesses and only take equity. You really need to optimize your capital structure. So we've seen from some senior and subordinate debt coming in from pretty low leverage to 1x recurring revenue or higher. So, $25 million on a $20 million business seems like a lot. From about a decade ago, it would have, $4 or $5 million for a more earlier stage, senior debt. So it's, just more efficient capital structures, but also more leverage. So I'd say that's the biggest change we've seen.
Great. So what is your investment thesis for the sector? What exactly are you looking for to invest in as far as the criteria?
So we look for software, but it also spills over to healthcare, primarily healthcare IT, but software companies, mostly enterprise, doesn't have to be, that are north of $10 million in ARR, so annual recurring revenue, with what we call controllable burn. So the thought behind that is if they didn't care about growth, they could probably be roughly break even, but they want to use capital to grow, thereby maximizing enterprise value. So that's that at the high level. So companies that might be able to be break even, but want to grow very quickly.
Do you have a couple of examples of companies that fit that thesis?
Yeah, I mean, in some old companies we've invested in, HomeAway was one of them. In Town, Retail Me Not, those are two of our bigger ones. But yeah, anything with a recurring revenue sort of software component, or it doesn't have to be necessarily contractual revenue, but for example, like a credit card processor, right, at scale, those are future revenues seem to be very predictable, but not necessarily contractual. So anything that has some at least perceived predictability in forecasting. That's why we focus really hard on the recurring nature and retention, because that really leads into the predictability of the business.
Well, for this sector, what are the challenges you find the entrepreneurs face? You talked about the fact that they just can't use equity to raise funding all the way up the curve. They have to start using debt and other structures along the way. But in running these businesses, what do you find is a challenge that they're trying to overcome?
We've seen a lot, especially on the earlier stage where we get in, around that $10 million mark. A lot of these companies have really great ideas that are solving really pretty severe pain points for their customers. So I don't want to say it's easy, but it's relatively easy compared to what happens when you grow to sell new customers. So there's not a big focus on customer retention because so many bookings, so many sales, especially if you focus on the small and medium businesses, the SMBs, that process is usually quicker. But as these companies mature into larger enterprise focused sales and just, the customers need more handholding and start to get more scale themselves, there really needs to be a big push on customer retention, customer success, training, maybe customized features for certain larger enterprises. And that's just a different skill set and a different, way of thinking. So there's a bit of growing pains around a certain area where the growth could slow down as new bookings might slow as churn ticks up. And that's pretty scary. So it's that transition from let's just sell stuff as short as possible to okay, we need to build out a customer success and sales team for a company 3 times our size that we can grow into. So that's certainly, and you also don't want to staff up too early because your burn is really high, right? You have to make the sales as well. So it's a balancing act that personally, I'm glad that I don't have to make those decisions. And it's really impressive when companies can successfully do that and scale efficiently. It seems really tough from the outside looking in.
Very good. So if you had to pick a couple of sectors or subsectors or applications you see out there as good opportunities to pursue in this space, what would you pick?
So just at high level, SaaS we like a lot, but enterprise software, we like HR software as well. There's a little concern there is, not if we peaked with that, because now it's full employment, right? What happens if we can't go less, right? The unemployment rate can only really get worse, but maybe that means some of the software could help with retention, or it's how some of these companies run their HR processes. So that makes the software stickier. But HR, SaaS, we really like. Healthcare IT, we like as well. I mean, we do healthcare, but not any FDA sort of, anything the FDA would touch, but patient check-in software, big data analytics with the healthcare, population health. Those have been, because it's a very, very complex and expensive industry, and anything that can lead to cost savings while improving patient outcomes, we think that those companies are really poised for outsized exits. But unfortunately, it's incredibly difficult to do. That's why they're so special when they can. See what else. Yeah, and just really any enterprise software with high retention. We focus a little more on metrics than necessarily sectors, as long as it's under that software umbrella. But those are the two that I probably work personally the most on.
Great. Well, in the last few minutes that we have, what else should we cover that we haven't?
Just that it's the buy side in this industry. It's so different from what I experienced in consulting and investment banking. I spent a little time banking as well. We're on the business school time, but with those jobs are very similar across different consulting firms or different banks. You get similar experiences. It's not the same, as a lot of it's based on the people, right? But similar programs, similar development, similar timelines of moving up, similar projects or deals. But with buy side, it's very unique depending on the group you're in. And it's, very, very competitive. Certainly there's less oversight as far as someone watching what you're doing. It's really a lot of the word self-starters used a lot, but you really have to be one. No one's over your shoulder, but you have to source deals, right? And that could take thousands of emails before you get a good one. So it's a lot of work that there's no necessarily immediate feedback on, but when it works out, it's really satisfying and really, really fun at the end of the day. So, I mean, I feel very fortunate to be on the side of it and be able to invest with the guys at Escalate. I really enjoy working with them, but again, it can get in the weeds going on business like BD trips and trying to draw up new deals can be stressful. So, but it's very unique from it's very common for bankers and consultants to transition into buy side, which makes sense because of the deal focused nature of the job. But there are some areas that are incredibly unique to the side that still getting used to now, but hopefully I'm getting some sort of mastery on them.
Well, that's great. Well, that's a good point for sure. So how best for listeners to get back in touch with you?
Sure. Our information is on our website. That's escalatecapital.com, and my LinkedIn as well are the two best. And then there's an email that's info@escalatecapital.com. That is a generic kind of catch-all, but the spam filter on that might be kind of tough. So if you want to talk to me, please feel free to just shoot me a note on LinkedIn.
Very good. We'll put that in the show notes. Appreciate your taking time today and hope to have you back for a follow-up soon.
Great. Well, thank you so much for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.